The views in this podcast are those of the contributors and don't necessarily represent those of CISL, the University of Cambridge or Investec, and should not be taken as advice or a recommendation. Welcome to What Next? Leadership Conversations for a Better Future from the University of Cambridge Institute for Sustainability Leadership in partnership with Investec. This series is hosted by Lindsay Hooper and Mark Kahn.
Hello and welcome to What Next? Leadership Conversations for a Better Future, where we explore how leaders can help build future-fit economies. I'm Lindsay Hooper, Chief Executive at the University of Cambridge Institute for Sustainability Leadership.
And I'm Mark Kahn, Chief Strategy and Sustainability Officer at Investec. Together, we'll bring fresh perspectives, provocative questions, and conversations with leaders who are shaping the future of markets, business, and society.
We're at a critical moment for African leadership in shaping its energy and wider economic future. The task is urgent. How do we accelerate an energy transition that addresses not only climate risk, but delivers for African citizens? Over recent years, we have seen remarkable progress, but this is also against a backdrop of decades of talk, too many flawed approaches, and we don't have time to waste. So in this conversation, we'll ask, what needs to be rethought? What are we overlooking? And what should be prioritised now? I'm delighted to be joined by two distinguished voices. Carlos Lopes is Professor at the Nelson Mandela School of Public Governance at the University of Cape Town and a leading advisor on Africa's climate and industrialisation agendas. And Jasandra Nyker is an investment executive and board director with deep experience in scaling businesses across clean energy, sustainable infrastructure, and climate technology in Africa and beyond. And together they'll help us explore what next for leadership in Africa's energy transition.
Lindsay, thank you for introducing our guests so beautifully. It is rather intimidating to be in the room with two individuals who are so instrumental in helping the continent move forward with the transition challenge that we have. I guess an opening question to both of you, and give us just a little bit of an insight into what personally motivates you to participate in this way, in this economic transition.
I think first and foremost, it's a really exciting time to be in the energy space on the African continent. There's huge potential, a need to marry energy with its productive use, and the importance of being able to use that as the tool to actually generate and improve economic well-being.
Thank you, Jasandra. And now to you, Carlos.
During my time at the United Nations and African Union, I saw major climate decisions being shaped without African input, and only for Africa to be expected to comply. And that led me to push for African-led initiatives like a sovereign carbon market, fairer investment terms, changes in regulation. Basically, agency matters. I think we have to stop seeing Africa through the lens of risk, start seeing it as a laboratory for reinvention. The continent is not a passive recipient of climate agendas and should not be. And the more we know about the links between climate and development, the more justification there is for us to look into the possibilities of Africa in a very different lens. Africa cannot afford to be left behind, it's true, but its transition should look the way the Africans feel it is appropriate. And my motivation is that I have seen how much is lost when the continent is expected just to follow models that are designed elsewhere. My motivation is that this work is about reclaiming agency, making the transition work for Africa for sure, not just from a climate perspective, but to catalyze on our structural transformation that has been lagging behind for such a long time.
If you were to crystallize in a single description the current African reality when it comes to the transition to renewables, how would you characterize the current reality?
I would say it very succinctly, some progress, but not enough.
I would say too much talk about climate finance and very little talk about investment.
So let's get into where focus is needed going forward and where you do see the potential. And I loved your initial framing there, Carlos. Of course, agency matters, but your framing around seeing Africa as a lab for reinvention. This is core to your work. It'd be great to hear your diagnosis of what's the fundamental problem that we need to tackle, but also your insight into what will a better alternative look like in more practical terms.
For a long time, because of the colonial past, there is this perception that the way we are going to help Africa get out of its problems, development challenges, is about altruism. And altruism has been shaped in different ways. It has influenced the way we look into the development aid industry. It corresponds to a frame that people are familiar with, that they have difficulties changing in terms of how they see the world. And therefore, Africa occupies a space that is almost necessary for people to feel altruistic. And that is a bit of the self-deception from, let's say, the donor side. The Africans also have the same problem because they believe their transformation is going to depend on development aid money. And therefore, they also end up in the trap of looking into the solution for all their difficulties through how much money we are going to get in these different negotiations. And that is very much the way we have been framing the discussion on climate finance. And I think this is completely wrong. What we need to look into is what are the regulations internationally that can be challenged in such a way that it will allow for Africa to prosper and it will allow Africa to have the right place that it deserves in the global scene. Because a lot of the policies that have been induced in Africa have been influenced by external eyes. Africans have now almost the obligation of changing this mindset. And I see 4 ways they can do it. The first, we have to look into dependency as a challenge that should be transformed into agency. We are still operating with donor-scripted mindset. That needs to shift. Africa must set the terms and define what is just transition, for instance, as the South Africa is doing. One that fits our realities. And I think the second aspect that is very important is that the energy transition is also an industrial and economic opportunity. And Africans have to look into this discussion, not because they have some obligations to contribute to mitigation worldwide. They have not been really the ones that have provoked the crisis to start with. This is not just about clean energy. It's about green industrialization. It's about job creation. It's about building long-term resilience. It's about energy as a platform for the structural change I was talking about. And it's therefore not just a technical fix, it's also a political economy question. And the Africans have to embrace it from that perspective. The third aspect is that we have a systemic financial distortions and regulations that are blocking our progress, like the cost of capital is the most obvious one. Africa pays the world's highest capital costs for a region that has the lowest emissions. It's like we have a financial debt, but we have a carbon credit. And I think we need to change that equation. We need to demonstrate that the two go together. Because if you are going to save the planet, it's a structural failure, not just a market failure. And we need to look into how the market and its outcomes are going to contribute to repair it. So issues like risk premiums, credit ratings, the Basel rules for prudential banking, the ESG conditionalities, all of those have been constructed in a way that penalize Africa. That was not the intention, but it was partly because Africans were absent from the table. And last but not least, I think Africa must be seen as a strategic climate solution. Because Africa holds the key to critical minerals, it has untapped renewable potential, the energy access for 1 billion people in Africa is going to make a complete reversal of the way asymmetries have evolved. So this isn't a marginal story. It's central to the global transition. And without that change in Africa, there will be no global transition.
I think this touches on something that, Jasandra, I know that you have got a view on. In particular, I think you've given a perspective on US aid. coming in, and the kind of dependency that I think Carlos is referring to comes into question here with the withdrawal of that. What's your view on the impact on Africa?
I actually think it's a blessing in disguise. I think it's creating a sense of urgency across many governments around rethinking how we are actually going to deliver to its citizens. And I think that's actually necessary, because for too long we've got too comfortable with knowing that USAID and similar agencies were going to provide those donor funds. Now we have to rethink and rewire ourselves in terms of how, and governments have to do this, in terms of how they're actually going to get there. How are they going to fulfill the promises that they make every 4 years, and how are they going to do it within their own fiscus? What could they actually bring in? And I say, well, so many of these donor-led initiatives that have happened, what they've really done is they've actually created parallel systems. One where they're providing a service just to some extent, but we're not really thinking through the longer-term resilience of an opportunity. And I think about this when I think through the energy equation. I think through this when we think about the education equation. And we're not really thinking about the long-term viability. How do we actually get to stand on our own 2 feet? And I believe that this is an opportunistic time to actually turn it around, pull out a blank page, and rethink how to actually go about what needs to get done.
Thank you. And I could see, Jasandra, that you were nodding throughout Carlos's very comprehensive and really clearly structured diagnosis there. But the question there, obviously, around US aid, interested in your view, who needs to be on board globally for this to happen? Is there a bigger space in future for South relationships, working with others such as China? There's been a lot of focus on the US and Europe. Situate this in a global context. Who needs to be on board, and what will it take to get them on board?
A lot of actors need to be on board, but I believe the most important actors to be on board should be the private sector, the corporate world. We have, for a long time, believed that some of the policies that are supposed to create the right incentives from the public sector were going to make the trick, and this has not happened. We are in an overshooting mode in relation to climate, and we need to actually look into what are the mega changes that are required for us to write our strategies. And I believe the private sector and corporate world are absolutely fundamental for it. And therefore, we need to create the conditions for that to happen. When it comes to Africa, most governments will tell you that the discoveries of gas in particular should be used as a transition energy, because they cannot afford having been for a long time the lowest contributors to the emissions, to now forego this opportunity. And I think we have to be cognizant of the fact that if Africa's cost of capital is 10 times higher than advanced economies, it's partly because most of the investments that are done in the continent are still going in the wrong direction. So the attractive ones are going into fossil fuels. I like to say that Africa really is not choosing some of what people consider stranded assets. It's because that's where the money is going. So how do we change that trajectory? I would say we have to stop seeing development and climate as two separate discussions. They are one discussion. If you talk about development finance and you talk about climate finance as separate tracks, it doesn't make any sense. It's about development that should take into account climate, because the potential for us to change our matrix, not from an energy perspective alone, but our industrial matrix is there. And you cannot talk about climate without taking into account the development needs. So let's change the paradigm so we can have this set of actors that have been a bit on the side participating more fully into these reforms.
Fully agree, there needs to be many actors to come to the table. And to the private sector, I also feel that it is the pension fund industry and the institutional investor industry that is local to Africa, the $3 trillion industry that's sitting out there, that actually needs to come to the table. And why do I say this? To a large extent, in most of the African countries where we're trying to roll out renewables, it is a local currency offtake. And FX risk has been one of the biggest challenges for international investors to think through the Africa story. And even if it is viable in a local currency, the hedge that is required for many of these currencies is extremely expensive and it becomes non-commercial. So when you have local private capital sitting in pension funds, how do you actually bring them to the table? What is needed in order for them to become that equity part of the equation? The debt side of the equation, I believe, is actually quite advanced. There's a fair amount of commercial availability of debt. We've had a lot of DFIs coming to these markets as well, very long lead times in terms of being able to convert and close these projects with that capital. But more and more, we are seeing that private credit market come to play. And that is actually quite, let's say, value additive in terms of it. It often starts with the credit markets. They get comfortable because they have security. But then it's how do you actually bring in the equity side? And we will need blended financing tools. We will need to look at first loss opportunities, first draw mechanisms that could actually come in. But it's also how we actually use that first layer of capital to be catalytic enough in terms of being able to draw others into the financing equation.
All right, so I've got a provocative question for both of you. Sometimes when I hear the cynics out there, they say things that suggest that there's not a misperception of risk when it comes to Africa. The risk is real, okay, and that it's just too hard. And even if you get somewhere with a deal one way or another in an African country, down the line, it ends up that you can't get your money out, or even if you can, by the time you actually get there, there's been some breakdown of one kind or another, whether it be in the governance process from a corruption point of view. And even if that's not the case, the direction went otherwise to how you had strategized in the first place. I mean, is there misperception of the risk from cynics like that? Or would you say there's some truth to that?
The risk is real within the frames that we work, but we need to change the frame. For instance, Sandra was just mentioning the pension funds. Let's start with the African pension funds. Where do they put their money? 80% of their money is outside Africa. So if you don't change that, how are you going to expect the foreigners in your neighborhood to be the ones that they take the lead and take what is perceived as risk? Part of the cost of capital in Africa is induced by this risk perception, and a lot of it is exaggerated. Let's take, for instance, some of the considerations that are made on the political side, because they are quite subjective. You will say that the risk is very high in certain African countries that have had growth patterns above 6-7% for a decade and a half, because their political situation is unstable. And then you will have a completely different behavior in relation to Thailand that has had 10 coups and is always in a political unstable situation. So why is Thailand treated differently from, let's say, Ethiopia? It's because we have these perceptions that are associated with the way we frame. But that is the external actors. What about the African actors? They don't create the right conditions for their own to invest. And that is a problem because the African pension funds have $1 trillion. So they can really make a complete reversal of the current situation if they were investing in Africa. And of course, we have also the issue of the foreign exchange that Sandra was mentioning. It is very true, but it has a lot to do with the way our central banks behave. They are very much dependent on a view where even when they have reserves, they don't put it in African vehicles. It's a complete distortion to expect that the others are going to save you when you are not trusting your own.
That's exactly right.
So we've heard your responses to that provocation, but my understanding is there is still an issue with misperception of risk. Jasandra, what are your views specifically on that?
I actually do agree with that. While no doubt there are real risks, but on the perceived risk side, I mean, there's little systematic evidence available to show that there's been a significant difference in default rates in Africa relative to elsewhere. In fact, I think it was Moody's in 2019 that showed that the default rates in Africa energy infrastructure projects was significantly lower than that of the US for the same asset class. And one has to then ask, why is that the case? Why do people think that these are risky projects when they're actually not? Well, when we actually structure and develop these projects, we spend a significant amount of time looking at risk mitigation. And we put in layers and layers of risk mitigation from that perspective. And that is what actually leads to these projects having that higher cost of debt. The hedging structures that we put in place, the way we look through debt and the costs associated with debt, all of these tend to add up. And that is why we have a higher financing cost, sometimes unfairly so. And as a result of which, we end up with this view around perceived risk.
I mean, if the challenge is a perception issue or a market sentiment issue or market confidence, what's the solution? If you're saying we've already got the data, we've got all the hedging in place, how do we bridge that gap?
I think it's partly thinking through the structure of the program that you're actually offering. So if you're thinking large-scale infrastructure, what are you putting in place within your offtake agreements, your implementation agreements that actually allow for those risks to be naturally mitigated as opposed to be compensated by an additional financing layer or an insurance product?
So we've heard a very good, clear diagnosis and layout of the domains where action is needed from Carlos. We've heard some specific areas where there are questions that need to be asked. But I'm interested to hear other practical examples that demonstrate what's possible. Where do we start? In practical terms, what's the next step for this necessary macro shift? Where will it take root?
Let me start in my own home backyard, which is South Africa and the South African Renewable Energy Independent Power Producers Program. Now, when the government decided that they actually wanted to go about designing this program, they thought through a variety of different aspects. What it would mean in terms of attracting capital, so both foreign investment, how to actually mobilize the local markets from a commercial perspective. What would it mean for the communities in which these projects would be built? What would it mean in terms of the supply chain that will actually provide the equipment for this? And how could they then use this program as a tool to actually catalyze economic development locally? Now, when the first RFP came out, and I'm talking here now 2011, it was very much a shock to the system for a lot of the foreign developers and investors who were looking at this market and going, oh my goodness, this government wants so much. But this government stuck to what it actually stated. It developed an auction program where it stated 70% of the points will be linked to tariff and the remaining 30% would be linked to economic development. So it was trying to use this to target two agendas: ensure that there would be cost-reflective tariffs in the market, but also that these projects, because the returns would be good, could actually help deliver on many of the things that we as a government could not do ourselves. Fast forward, I think we've just finished round 7 of this program. The policy and the regulatory environment which they created for the delivery of this stuck. And I think that's the important thing, is that they ensure that there were very clear lines on how to actually play the game, what policies in their country needed to change, and they did take a ton of feedback into play over the rounds in terms of what could actually be improved, many disgruntled investors along the way, but it became the most competitive energy auction at one point in time in the world because tons of foreign capital wanted to come in because it was well regulated, number one. And secondly, it was delivering for a government a lot of socio and economic aspects that were much needed in terms of uplifting the communities in very rural areas. It has been a program that has delivered close to 12 gigawatts of renewables, but has also done it in a manner that has resulted in the creation of a local industry, in the creation of a local supply chain to some extent, and in a very strong and well-regarded internationally service-oriented environment that actually can deliver now globally. Now, if I think through that, through a commercial lens around lending and what that has done, there was very little at that point in time, OPEC funding coming into this because you had a commercial lending environment that was quite interested and attracted to actually participate. And if anything, dominated in terms of the provision of debt into this market. You had equity coming in two ways. You had foreign capital coming in, but they could not be more than 60% ownership on these assets. And you had local ownership that was actually funded through local DFIs, through very unique blended financing tools that ultimately created long-term ownership, but using debt instruments to do so. And I think if other countries could take examples or take what was best in class of this program and try to leverage it as they roll out utility scale renewables across Africa, I think that would be highly relevant and value additive. In some other instances, you've had sovereign risk being offset by government support. Good examples of this have been in Egypt through the Benban projects. We've also seen this in Lake Turkana, which is a transformative wind project in Kenya, where partial risk credit guarantee has been put in place. And as a result of which, it created a lot of value add for international investors to say, this is something I'm comfortable with, this is something I can do. And that's how it's actually allowed for the attraction of capital.
Great example. Carlos, interested in your diagnosis of where we start practically.
Well, first, we have to make the case about return of investment being so good in all climate investments in the continent. They are good from an economic perspective, but also from an ethical perspective. You may have, for instance, projects on green hydrogen in Europe. They are financed to a large extent by public money, but their return of investment is always going to be lower than what you can get in Africa. But this is not a new story. Let's say, for instance, a company that is the leading company in terms of extracting bauxite and transform it into aluminium, like Rio Tinto, will always take the assets that they may find in Africa, in this case in Guinea, which are the best in terms of grade in the world, as just something that they put aside to protect their investments elsewhere, in this case in their home country, Australia. So how do we get the market to work as a market and not just protect assets that are not the best investment in terms of returns? By making sure that the Africans take, once again, agency very seriously. And I think one of the possibilities to do that is by making sure that they create the conditions for their assets to be valued differently. Right now, that's not the case. It's a very extractive type of behavior rather than looking into the value chains and the potential for adding value. And I think this is possible, and some countries are already doing it. It's very curious to note that the countries that are the most advanced in this kind of transformation are the countries that are poor in terms of natural resources, commodity exports. So that's a story that justifies itself in terms of when you are into the extractives and commodity exporting, you are more prone to accept change. And then at the continental level, there are a number of things that can be done. I will just mention one that for me it's probably the easiest to pick, which is carbon markets. So the European Union has a European Union carbon trading system that has created incredible value. And we are still in debt swaps and having volunteer market credit being offered with value that is more or less 20 times less than in Europe, because the way it works is a volunteer market. And, there is no such a thing as a volunteer market. It's either a volunteer or a market. So if you want to really make it a market, we can regulate that market in a way that is favorable to Africa. This is within reach. And we just have the lessons of Europe to copy.
I love that framing. It's either voluntary or it's a market. I will definitely be stealing that, and we're giving you full credit.
We've talked about the deep paradigm shift that we need in Africa. There's a leadership question in that regard in Africa. To achieve the paradigm shift that we're talking about, what is the call to African leadership that is needed here?
Well, I like to distinguish African leaders in just a very simple typology. You have reformists and you have rent seekers. And then I try to abstract myself from all the politics that are very confusing. So if you really are dealing with the need for reforms and you are going to work with the reformists, there are three ingredients that are absolutely essential. The first ingredient is ambition. And I think ambition, it can be defined as your capacity to anticipate a number of developments that are going to take shape, because we are in a world where megatrends are accelerating, particularly three: demographics, technology, and climate. So if you don't understand the dynamics of these changes, you are not going to be able to define your level of ambition. So it's not ambition for ambition's sake, it's an ambition that is grounded in your capacity to strategize along these changes that are occurring. Then once you have done that, you need the second ingredient, which is about focus. You'll end up with a very long list of things that you need to do, but you have to prioritize a couple of things that are going to be essential in your specific context. And I think a lot of countries have managed to do that along the last decades, particularly in Southeast Asia, as we know. But we have more and more countries in Africa that are following the same sort of pattern. So that is very encouraging. And then once you have focused, your priorities are defined, you need a third ingredient. And that third ingredient is basically coordination or alignment. You need to make sure that your set of actors that are essential for this transformation and priorities to occur to be on the same page. And this is very difficult because you will end up with governments that may sound as modern and respectful of constitutions and all the rest that have no clue about how to be on the same page. So you will have Ministry X and Ministry Y having their sectoral policies completely disjointed with this national interest and this national priority. So how do you make sure that industrialization is not the business of the Ministry of Industry? It's the business of everybody is the challenge.
I like to use two examples where I've seen the change. And I like to use Morocco. And as a result of what happened during COVID, they were quite concerned around the extent of imports that they needed in order for them to actually deliver to their people. And they decided to take, I think it was 270 market opportunities and actually convert and build them out. And what they really did was actually create 270 companies for each of these specific needs that they were highly reliant on overseas to actually bring it in-house. And what that showed me is that they really focused on getting things done and getting things done as quickly as possible because there was the sense of urgency given that we were in this COVID environment. The other country that I'm quite taken by is actually what Zambia has done recently in terms of how they're thinking through their policies, how they focus on their 180-day plans in order to make sure that they can get things done. And I think that execution, that desire to get things done needs to be front and mind in terms of being able to deliver. There used to be the saying about, in order to get power, you have to be in power. And there was often a saying, particularly African energy conferences, in order to get power, you need to be in power. And it was really talking about the importance of the political players and the leadership in terms of ensuring that you could actually deliver energy access. And I think it's more about getting things done, making sure that you actually want to deliver something. And it should be within the 4-year term that you've been given, how you actually want to roll out. Within the Zambia context as well, just thinking through what they've been doing from a distributed renewable energy perspective, how they brought in new laws, how they've actually thought through access at a very rural level. The focus was on just getting things done.
You've both highlighted the importance of engaging the private sector. You've talked about Africa's own financial sector and pensions, but I understand, of course, there's a need for wider global capital markets to be engaged. And just to recap what I've heard from you, I've heard support for good governance. I've heard support for and engaging with the effective shaping of markets. And I've heard the leaning in to create the conditions for assets to be valued effectively. Is there anything else? What are we missing about what the private sector could and should be doing now to accelerate progress?
Well, when you look into world history, there is no doubt that demographics has played a very critical role in the trajectory of the economies that have been successful. And therefore, it will be a mistake for the private sector generally not to take into account the fact that most of the population in the world is aging. And this aging is going to accelerate in a number of ways because the fertility rates are extremely low and the progressions in terms of science, technology will allow people to live much longer. So we are going to have societies that are going to be dependent on a very different type of understandings that we are accustomed to. And in this, Africa represents an incredible asset for the world. So that is one very exciting opportunity for the private sector. Then add to that what we have been saying. 70% of the world's cobalt is in Africa, large shares of lithium, manganese, graphite, platinum, and so on. And all of them have very little beneficiation. And it would be interesting to marry the first point I made with the second. So more and more, you are going to be able to create jobs that are going to be beneficial, not just for Africa, for the rest of the world. The same goes into carbon credits that we're just talking about. It will be in the interest of the world that the carbon value in Africa is taken into account in different calculations. For instance, the fact that in terms of the capacity to sequestrate carbon, the Congo basin is now more important than the Amazon. So all of these are economic opportunities. We just don't see them right now because we are still trapped by the way the economies have worked, which were propelled by fossil fuels. But in the future, it's going to be very different. So Africa is going to be a huge, incredible opportunity. So the private sector has to start pushing themselves into ways of looking into the valuation of their business very differently. And that's what I would argue some countries like China are already doing. After attaining the peak of emissions and being sort of the culprit of a lot of the problems that we are facing collectively, they are now transitioning into what is arguably the next big wave of transformation, economically speaking. And when we look into artificial intelligence and how it's going to upend the way we deal with intellectual property, the way we deal with rules that have been based on intellectual property, such as the trade rules, we can expect that these dramatic changes are going to be beneficial to countries that up to now were a bit taken out of the ring because of the asymmetries that we grown accustomed to. So the world that is going to unfold before us is going to be very different, and Africa will represent an incredible opportunity.
In terms of the population and the opportunities that that provides, I think that is something that's key. But we also need to think through the population opportunity in terms of what the needs of the world will be going forward. I think it's a lot to do with data. It's around technology and how then certain parts of the African continent can become those hubs and those centers of excellence in that regard as we skill up people and actually create those opportunity sets.
I just want to acknowledge that these are huge topics, and we're actually having conversations specifically around AI and part of that, the impacts on global labour, but also a focus on youth unemployment, young people and young people's futures. So, Jasandra, I'm really interested to get your advice. How would you best mobilise private capital to catalyse economic development and competitive growth, and specifically in the context of energy and infrastructure?
So I think there are two key areas that I would like to focus on in this, and it is quite a broad area. But I would first and foremost want to align investment structures with local realities. There's no one size fits all. We have 54 different nations here, and it's really important that we ensure that the private capital flows, structures are aligned with market realities. And that means longer tenders, blended finance, risk mitigation tools that reflects Africa's macro conditions, how we take currency volatility into account, what we look at from a political shift perspective, and last but not least, but very important within the energy concept, is utility credit worthiness. And here, as we think through blended stacks of capital, what are those concessional anchors? Who provides them? Who provides the first draw or the first loss? How we think through mezzanine in order to uplift equity? Those are all important. I also think when we're thinking through energy infrastructure, it doesn't necessarily always need to be utility scale projects connected to a utility. But as we are growing the economies in Africa, within the fence generation for industrial off-takers. And I think that's really important as we think through how we bypass weak grids and de-risk revenue. I'm currently working on a project in the DRC where there is a large mining company that is thinking through a solar and battery storage generation solution within the fence in order to better manage their energy security, but also to ensure energy supply that if they're challenged from a diesel perspective, they have something else to rely on. So also creating that redundancy. The next part of it for me is also we need to anchor energy investment with productive use. Initially, over the last 2 decades, we've seen a lot of, let's just build a larger scale project and we'll connect and we'll leverage government. But what happens where there is no grid? What do we then look at? And here, bringing in distributed renewable energy with mini and microgrids, but linking it to productive use has quite a multiplier effect in terms of what it can deliver. So this in itself will create jobs. It will also enhance and create value for the jobs that may already exist. It also improves the economic offerings that we provide. It value creates a product. And a good example I'm going to use is the agricultural sector, where in Ethiopia at this point in time, there are initiatives, and it's philanthropic capital that is actually driving this, where they're allowing and promoting women to own small cooperatives that ultimately harvest the coffee, but then actually participate in that first level of processing in order to increase the value of it prior to export. And I think that's really important in terms of how we can link energy to agriculture, similarly into digital infrastructure and manufacturing, so that you actually increase the value of the job, not just generate the job, and then also improve GDP.
Thank you. Really great examples that bring that to life.
Carlos, you were mentioning earlier about the importance of cooperation as one of your key actions for a successful future for Africa. I wonder if you could expose some of your thinking in terms of cooperation between African states and the degree to which the lack of geopolitical cooperation has reduced the leverage that the continent has to control its own economic destiny, and what you see as a way forward with regard to regional cooperation in that regard.
I believe very few people will accept the fact, although it's accurate, that Africa is the third largest trading partner of Europe after the US and China. And the reason is because there are 13 different trade agreements between Europe and Africa. So Africa does not trade with Europe as one. This is very telling, because it basically diminishes and smashes the possibilities for Africa to negotiate in different terms its engagements with the rest of the world. And if you look into the history of regional integration in Africa, you go all the way back to 1980, when the Africans draw a plan, the Lagos Plan of Action, it was called. And then they realized 11 years later that they hadn't been able to implement most of it, if any, of the premises of that plan, and end up with a template called Abuja Treaty that was about integration, about what you just mentioned. And this Abuja Treaty was another failure. It has not been really instrumental in creating the tools that would allow for integration. So when I was confronted with this question at the Economic Commission for Africa, my concern was that each time we're looking into the optimal instead of the practical. And we had a second problem, which was the fact that we were looking into integration in a separate tracks. And there was a need to understand that integration is a composite of different elements. So I ended up proposing the establishment of an African Regional Integration Index that is now being done jointly by different organizations in Africa. It's a compositive index that measures the extent of regional integration in different dimensions, basically 5 key dimensions. The first is trade integration, obviously, and we have now a continental free trade area, so it has been a bit slow to start, but is gaining momentum and definitely is going to change the landscape. But then you need productive integration, which is your value chains that have to cross borders and have to be capable of understanding that if you are going to create an African market, you need also to have African goods, African products, African offers. Then you go into the macroeconomic integration, which is the convergence of a certain number of macroeconomic policies, but beyond that is also making sure that we are instrumental in creating the possibilities for us to finance our development. For instance, if you put all the multilateral financial institutions in Africa together, including the African Development Bank, they represent about 1% of the global multilateral institutions devoted to this type of focus. So that is very, very small. And then you need to go into the infrastructural integration, which is your roads, your bridges, your ports, basically the logistics that will allow us to trade with one another, but also to make sure that we integrate our economies. And last but not least, the free movement of people. If people cannot circulate, it's going to be very hard for business opportunities to arise. And it's not impossible, but it's going to be much more difficult. So this Pan-African integration framework has to be comprehensive. Otherwise, it's going to be scattered initiatives here and there, some progress, but limited in terms of their impact.
So I think for regional cooperation to actually work, it's going to be very important for political leaders to come to the room thinking through how it's actually going to benefit their citizens and their economies, and to perhaps leave their egos at the door. I think that there is a very strong focus on country first as opposed to regional cooperation. And how do we then show that they can actually bring and integrate the opportunity set to actually have a win-win for all?
Are you optimistic that we'll see this, that we'll be able to achieve this?
I think in some regions, probably yes. And maybe in others, it may be a bit harder.
We've spanned the macro context and framing right down to some of the micro actions. We've covered mindsets and on-the-ground deals. And what comes out really strongly is the huge opportunity here and the need to really reframe and take action in line with the scale of that opportunity. But before we close, I'm keen to turn to each of you and hear your personal key messages, key takeaways.
I would say that we need to see Africa's energy transition not as a charity case, but actually a massive commercial and economic opportunity. And how we actually link that together is actually quite critical. How do you bring in local ownership? How do you ensure there's risk-aligned capital? And to me, I'm really excited by that opportunity. I think the private sector does need to lead, and it's how we actually bring them in and how do we actually get it to be accelerated. And I think that's really important as well.
My key message is to say that latecomers come with a lot of baggage and a lot of problems, but they have also some opportunities that are unique to them. They can leapfrog more easily than others that have to deal with legacy. They can also offer opportunities for growth that are no longer available to mature economies. And they can definitely point in terms of the possibilities of the future when it comes to demographics. So Africa offers these assets that are intangible to a certain extent, but should be more and more incorporated in the way we define our trajectory.
Thank you, Carlos and Jasandra, for joining us to explore Africa's energy transition. We've heard about the importance of shifting the conversation from one of dependency to agency, and for investors to shift from seeing Africa as a place of risk and rather to see it as a laboratory for reinvention. We've also explored the importance of not approaching energy transition simply as a climate mitigation imperative, but rather to see it as a driver of necessary industrialisation, of job creation and long-term resilience, and to prioritise approaches that really engage the private sector and institutional investors rather than relying on governments and donors to provide the necessary capital. And to enable that, we talked about the need to tackle systemic financial distortions, such as the high cost of capital and risk premiums that are often grounded more in perception than evidence. And last but not least, we talked about the importance of reframing Africa and its energy transition as a strategic climate solution based on its critical minerals and renewable potential, and to see that transition as being central to global transition. Join us next time for What Next? Leadership Conversations for a Better Future.
This show is presented by Lindsay Hooper, Chief Executive of CISL, and Mark Kahn, Investec's Chief Strategy and Sustainability Officer. The producers are Carl Homer of Cambridge TV and Alexa Selwood. The executive producer is Gillian Secret, and it's produced in partnership with Investec. Thank you for listening. For more episodes, subscribe on any major podcast platform or visit the Leadership Hub on the CISL website or Investec Focus. You'll find the address in the show notes.